Hi there, Alpha Team Planty here, and just look at the new merch. Can't beat it, can you? You'll all want one of these. Absolutely fantastic, good quality. Be available on the store. So we've had a lot to say about commodities, gold, etc. I think silver is the one that I've seen the most interesting stuff on over the weekend. Lots of tightness in that market. Historically, it does catch up with the gold move and overtake it at times. So that very much looks like it might be at the bottom, really at the bottom of the consolidation pattern. The gold is still trying to find and confirm the bottom. So look for the silver lining. And that reminds me of one of my favourite jazz artists, Chet Baker. If you can ever get hold of a copy of that, his trumpetry is fantastic. And the lyrics are interesting, especially for prop traders. Talks about the daily grind and looking for silver linings. Whenever a cloud appears in the blue, blah, 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 you've got to look for, don't look at a negative. It's a classic, is the glass half full or is it half empty? And I think that is very much where we potentially are in the markets, and we'll chat about that in a minute. And occasionally I like to see things in the bigger picture, and I'm hearing silver, and annoyingly I'm hearing hi ho Sheffield Wednesday to the tune of hi ho Silver Lining by Jeff Beck, and they hijacked that to create one of their anthems. Unfortunately, my Sheffield team, United, got relegated by Alex's Toonami, and Sheffield Wednesday look like staying up. Now, to me, their manager, and it pains me to say it, but you've got to be realistic, and that's what we are. Danny Roll came in, and they were dead and buried, going back down to Division 1. How he's kept them up, no idea. I think he's manager of the season, and that's coming from a blade. But index-wise, we've talked for weeks going into Q2, etc. 3, 4, 5 heaven. To me, we talked about those top in threes. We were looking for fours, and that sort of capitulation sells into April the 19th very much looked like we could bounce whatever, whether we're still going down, there should be a bounce. And net, we've had that last week. It's a big decision time to make now as to whether that was just a connector or do we see further downside. You might have heard lots of people beginning to chat about it. 5% pullbacks are the norm on an annual basis. You'll have 10 to 20 of those. It's the 10%ers that are the rarities, only one a year on average. My opinion is that we carry on moving up. Nvidia comes in the middle of May, and that is when we potentially top out. A 10% pullback from there would just bring us back into that 3, 4, 5 repeating heaven. So it all, to me, lines up. Still more upside, and I want to play that. And then we'll look to consolidate around the end of May. Now, I also came across some people that I saw years ago, and they look at cycles and timing. And then they started talking about the moon and planetary lineups, and I started to get a bit all glazed, thinking, what are these literal lunatics talking about? But they equally said there's only a small chance of it being a connector, that however things align for them, and that's why we put up that picture on the weekly preview about the asylum and the lunatics. Their central case is for a big high in May as well. So, if Nostradamus is thinking the end of the world is delayed, then let's not ignore him. FTSE, that looks like it's going to kick on again. That had a weekly closing, certainly had a weekly high. I can't remember whether it closed at high. We'll look at that in a minute. But given the acceleration of the bids that are coming out, there's lots of M&A activity. Dark Trace got bid for on Friday. BHP in the tight mining space, looking long-term, looking to shore up the copper industry, take some costs out. I don't think they're doing that at the top of the market. I think they're expecting things to push on to ever more highs. So keep an eye when the bid money's coming in. It's telling you that the UK is cheap, and there just seems to be a sentiment change. I said a few weeks ago I was going to probably change that chart from being a consolidation topping out one to more impulsive, and I've done that, and it does look like we've got some more upside. I mentioned gold and silver. Silver could have a 10 to 20% move up from here. If you've got a geared way of playing that, I wouldn't put you off. Dollar, to me, it's putting in ones and twos and looking to put in that downside nest. It doesn't have an obvious trend yet. Keeps coming back. There's a little downside channel we're looking at, and should the yen intervention trade start coming in, then you'll have a definite bit of selling short term. It's just a case of seeing what backs up. But the fundamentals have gone against the soft dollar, hasn't it? It looks like we've got 2 days left to get it down on the month. It's up 1.5% for the month. That, as we know, is not seasonal. That's in the 33% of occasions when it doesn't rally. But you never know. It could. Anything can happen in this market. It's crazy. I mean, the way I look at it is, given all the geopolitics, all the pushback on rates, all the inflation push out, why is the dollar not at 110? We talked about extension patterns on it. We'll look later, but there is obviously mood afoot. We've been talking about Europe and emerging markets seeing flows seasonally, normally, and that does seem to be backed up. And I'm hearing lots of strategists talking about Europe as their favoured players. It's coming out of the PMI slump, the PMI composites. That's when you add in manufacturing and services together. All jumped up recently last week. So there's an underlying bounce current there which should support the DAX, the IBEX, the FTSE, etc., etc. Commodity currencies, though, will probably outperform. We know that there's the industrial production side kicking in from China, and if the yen does carry on being weak, that is the carry currency of choice, isn't it? So that's the reason why you suggest backing yen pairs, because the yen will be borrowed against to invest in the outperforming areas. So I'll represent, I think I mentioned it midweek, but the expanded flat on the Japanese yen look like on UJ looks like it's over, because the ratio, which we'll look at between the down leg and this current up leg, have now got so strong it's beyond where it normally turns for an expanded flat. So I think with the fundamentals, that is going to break out to the upside. EU, Euro, US dollar, I mean, that has been resilient. We said last week, if the dollar could put in a new high, then the EU could put in that final low, but it's managed to hold on. Keep that previous low in mind as the stop loss. There's potential for another failed near retest, but it's not mega probable at the moment. I still think that's going to break out. There's a bit of chatter amongst the talking heads last week in Europe that, whilst June is probably favourite and they definitely go in July, they're not. A lot of the big hitters are not keen on doing more than or not signalling more than one, even though the market thinks there's still 3 or 4 cuts coming. So that might just keep a bid under the euro side of things. I'll put it now. There is going to be a live show on Monday. I don't know whether you'll see this first or that, but apologies for Friday. The setup just blew up. We're trying to find ways of knowing when the cache is full, etc. So what did happen last week, the stuff I was going to talk about on Friday before, which was obviously going to be before the close. It was a big week for the Mag 7, wasn't it? And semis. We showed last week on the preview how everything was looking end of the world stuff, but things were set up for a bounce. We got that in the SOX index, semis and tech, ex Meta and Intel. Intel, funnily enough, struggling. Just seemed to have delivered. Alphabet off the clock, and Microsoft. And listening to a lot of the analysts on Meta, this was a bit of a punishment trade for what they deem an arrogant delivery by Zuckerberg. That take out the Reality Labs pet project, and the underlying wasn't that bad. And if it had been a little bit more conciliatory and less taking the market on a bit like Musk, invest in me or walk away, then it might not have been hammered as much as it was. As it is, Alphabet and Microsoft showed that the fundamentals are still in place for the whole AI case and the cloud side. Said PMIs in Europe particularly were strong. US GDP showed us that the core PCE, the underlying inflation, unexpectedly jumped out. We talked about how that would follow through on the read through for actual PCE on the monthly basis on Friday, and we said it was either going to have to be a sign that January and February had been revised up, or there was going to be a monster positive on March. As it came in, which I think is risk on. If we knew that January and February were big outliers, ended up being strong in PPI and CPI, but it hadn't come through in PCE. That's resolved itself. And if anything, if the actual true position for March had been put through as consensus, then you'd have been looking for a 0.5 print month on month, and the actual 2.9 run rate dropped back to 2.8. So it was a good risk on relative print, and not a disastrous runaway one, but obviously the trend is now not ideal. We're not getting the fall away in inflation. Everyone said it was always going to be sticky, and relative to last year, as Williams had said, that was a surprise how quickly it fell last year. They expected a bit of stalling. Things are still moving down year on year on various metrics, or flatlining. We're not necessarily blasting away to the upside. And as I said, looking at the GDP print, everyone's starting to mention stagflation because that came in lower. But my classic C plus I plus G plus X minus M aggregate demand. M is the imports. If imports are high, and that's normally a sign of strong domestic demand, even though the US could stand alone, they're still importing. Then that takes a negative off the GDP number. So if that had been a miss on the US owned consumer or business investment, then that's more of a valid argument to make. But when it's down to actual activity, but in the wrong areas, that's not necessarily stagflation. So listen out for what people are saying, but look at the numbers yourself and try and follow some of the things like I like to follow, and I'll keep trying to teach is the things to look at. If anything, and on the basis of looking through that, it's growth trumps everything, isn't it? Horse winner is still there while the earnings are coming through, while the data is saying we're okay, we can just treat the rate cuts when they come as a bonus. But there is a global issue. If the States actually keeps putting pressure on, they will have a problem. But given the fact that their fiscal side is out of control and it's $1 trillion, $1 trillion a year they're putting on, I think, onto the net debt side. The net debt is just completely out of control. We'll talk about that in a minute. But what have we got? What else we got looking ahead for this week? So a little bit more Mag 7. We've got Amazon and Apple. Amazon on Tuesday, Apple on Thursday. And Apple potentially has been beaten to bits, hasn't it, with investigations and the antitrust investigations, a handset relative falls in China by domestic over US, etc. But they've got a joint venture with NVIDIA about Vision Plus. There might be a big upside on that to come. One person who will be watching it is obviously Warren Buffett, 5.86% shareholder, biggest holding in the Berkshire Hathaway Trust. And even Jim Cramer was jumping up and down and saying, how come Apple and Meta have had all the headlines, blah, blah, when really the bigger story was how good Alphabet was and actually paying a first dividend and seeing sequential growth. It's crazy, isn't it? Tesla got a relief rally, but I don't really know how to look at Tesla. We must have got 30 billion cash on the balance sheet, and he's telling investors where to go. But it was nice to see the bounce. But like I said, NVIDIA doesn't report until mid-May. I think we possibly grind higher, have a breakout on the back of that, and that's the time to start thinking that maybe we'll have a proper consolidation. Big week on the bond side of thing. That will struggle if we've got inflation coming back and stagflation. So there will be a little bit of fading and the continual massive auctions that are out there, keeping it under pressure. If we've got inflation, you want to be looking for free cash flow stocks. That is some of the tech at the moment. That's different from the 2000 crash. But also energy stocks and utilities, they throw cash off. So there might be some rotation in the next month or so if things don't calm down, dollar and inflation and interest rate wise, into those more inflation-friendly sectors. We've started to see the 2-year yield go up more than the 10-year yield, and we've already got an inverted yield curve. Someone said on the chat, is that a bull steepening? I said, well, I don't actually know because it'd normally be a bear flattening, but we've already got an over flattened curve, and that's going even more flattened more steeply on the flattening side. We don't normally have these things. I'd have to speak to an expert on how we describe the yield curves for that. ISM is back on its normal pattern of being first and third of the month, which means Wednesday and Friday this week. We've also got non-farm payrolls. In terms of ISM services, they've been quite strong on the S&P Global reports that we've seen, and the US GDP suggested most of the strength had come through in the service sector. So again, look for the headline ISM services to be okay, and it's all about the prices paid. It'd be lovely to get a follow-up negative month from that, just to get the market back on an even keel in terms of the rates. And that was, remember, from the housing and rental side last month, starting to come through on CPI slightly, but this would be nice to get a bit of sequential negativity into that kind of prices paid side. Outside that, we've also got ISM manufacturing, as I said, on Wednesday, got JOLTS and ADP, other employment data on Wednesday. Friday is the daddy boy non-farm payrolls, but as we've been discussing, it's lost some of its impact of late because of all the part-time jobs really picking up the slack. You must look at both reports, household as well as the establishment, and then you'll see where the trends are, not just what the headline figures are. And to me, the danger is because so many part-time jobs are being taken up, there's lots of chatter about savings rates being burned through. If we start to see full-time jobs actually start to go down, then that is the sort of signal that the Fed are looking for to possibly having to defend a weakening economy, because these numbers are a little bit backward-looking. So yeah, it can be a busy week data-wise. Excuse me. Yeah, it's the on the fiscal side of things. Yeah, it's $1 trillion annual interest rate payments by the US at the moment, and that's gone up from $450 billion at the start of COVID. So no wonder they stopped putting interest rates up. They're already bankrupting themselves as it is. Interesting stat I saw this week was Biden proposing 44.6% capital gains tax. Did you ever imagine that the king of capitalism, the US, would be the one stealing your money back? But we said last week, the thing that's missing from all this largesse, all the printed money, is normally spending cuts, which is not happening in the US, and taxes going up. Obviously, Biden's preparing the runway in case he gets back in. But sooner or later, globally, there's going to have to be a reset of some sorts. Obviously, we've seen the impact on commodities for suggesting it's going to be the blow-up case, or the revaluing fixed assets to pay down debt. There's been preliminary information from the BRICS that they are setting up their own currency. It's only another step to go, whether they talked about using blockchain and possibly asset backing it. Lots of details, very murky, could go lots of ways. Does that kill Bitcoin, or does it move Bitcoin into the forefront? Does it mean that gold is going to be in that party, 15% backing, as we've suggested? All still there. The underlyings are still there. So I still think it's buy the dips, look for the pullbacks, and we'll look at that chart coming up. So just to run through the data quickly, Showa day for Japan. Let's see them spending, hopefully. Those Tokyo CPI figures were dreadful. We didn't need that. German and Spanish CPI coming through on Monday as well. It's a bit of a quiet day outside that. Japan industrial production and retail sales. Doesn't sound like there's been a lot of strength in those, but we'll see. China PMIs, New Zealand money supply, Eurozone whole zone CPI and GDP on Tuesday. GBP gets the money supply, credits, lending figures from the Bank of England. They're normally well watched. Then the US employment cost index. Not many people look at that, but the Fed does. That's a kind of aggregate thing. They look at that rather than the monthly wage data that comes from the non-farm payroll report. And house price indices for US. I mean, if this was 2008-9, that would have been the biggest, most watched piece of data. It's hardly looked at now. Wednesday, New Zealand unemployment, Aussie PMI, and obviously they're in a bit of a kerfuffle with their CPI being strong last week. GBP, got the nationwide house price index. It's either Wednesday or Thursday. I've seen it on both days, so we'll see which one it comes out on. I've mentioned we've got manufacturing US PMI and ISM 15 minutes apart, slightly different indices looking at the same thing. JOLTS and ADP and construction data, so a nice forward-looking one for you. And then the Fed rate decision. The press conference will be of heightened interest, even more than usual. See what Powell the Towel can say. Thursday, Aussie's trade data, US productivity, that's the real key thing. If that number keeps beating, the market will like that. That means we can have growth without needing the interest rate cuts. The margins will take care of themselves, and it should keep long-term, medium and long-term inflation quite mellow. Canadian trade data, and then US Fed balance sheet in the evening. Friday, huge macro day. Aussie PMIs on the services side, UK services, US non-farm payrolls. It's all about the part-time, remember. S&P Global PMI as well, and the US ISM services. I've mentioned what we think about the read-through from GDP. Earnings-wise, still got some biggies. We've said it's a couple more Mag 7s. Monday, Sony, Bats, Philips, and Vivendi. Philips they were mooted to maybe doing some kind of spin-offs. We'll find out about that on Monday. Tuesday's Amazon Day, 1.7 trillion. Can that get over the 2 trillion mark? Like Alphabet. Adidas, will it earn its stripes? Carlsberg, will it? If Carlsberg does updates. Coca-Cola, Eli Lilly, and I think Novo is out on Thursday. They're the big obesity drug plays, aren't they? So look out for impacts there. It's a bit of a retailer day, though. McDonald's, Starbucks, and Coke. HSBC, they often have a bit of a curveball. We need to keep an eye on them. AMD and Samsung keep up the semi-trend. Glencore, historically big commodity traders, so always looking for comments from them. Lufthansa, will they get off the ground? Wednesday, MasterCard and Qualcomm, Pfizer, KKR, I'm interested in to see what they say about this current M&A trend. Is that going to continue? Glaxo, Barrick Gold, remember the big takeover last year? They're the daddy boy play. Have they got anything positive to say from this new gold price, or is it... are they getting hurt on margins against that? That is going to be a big bellwether for the gold play. And next, their updates are normally very insightful for the UK economy, so look out for that. Thursday, we've said Apple, is it at maximum negativity? Novo, we mentioned. Got Shell, Linde, and ArcelorMittal, again, a commodity bellwether on the steel side. Friday's pretty quiet. Danske Bank, Denmark, CRH, for a bit of global construction materials, really. And Daimler Trucks, that's normally looked at for the industrial side of things. Talking heads, no Feds until FOMC's out of the way. Bank of England, they're on lockdown for next week. Haven't seen any Eurobody speeches looking at their website, but I'm sure one or two will turn up. But, not many people voted on the list. Wednesday, we've got the Bank of New Zealand, Governor Orr has a pop. You've got the Fed rate decision. The Canadian Deputy Governor Rogers and Governor Macklem both speak in the evening. Rogers and Macklem again on Thursday. Buber's Baltz is around, and nothing at the moment on Friday. Saturday morning around 1:15 on Saturday. You've got Gouldsby and Williams at a conference. So shall we have a look at some charts? So charts-wise, yes, oil has moved up this last week on the drawdown from those unexpectedly high inventory figures. But production-wise, Canada are coming back on, adding barrels. OPEC possibly missing out like I suggested they would. The US is smashing at the moment, producing 9 million barrels a day. That's just keeping a lid on the gains. Keeping it less impulsive, but grinding up in sets of 3 waves all the way. And the fourth wave overlap 1, that suggests a leading diagonal. It's valid. and we should see a breakup out into the 90s before that properly fades, and then obviously could go further if the inflation argument takes hold. But yeah, stick with that until we see any evidence that global demand has fallen. I was going to put a GDP components chart in, but I forgot. That would have shown you pictorially, quite obviously, how imports was the big downside of the lot. But again, I've mentioned that isn't the negative people are talking about. That is demand in the economy for overseas goods, for inputs or purchases. If any other part of the aggregate demand curve, the consumer or business investment or government was falling, then that would be more of an issue. So it's a good negative. The CME tool, meanwhile, that's now pricing in more likely chance of no cuts than two cuts, which I think is harsh given the fact that most people haven't even realised that the November meeting is after the election. They pushed it back by an extra day. I keep talking about it. So the two cuts could easily come after the election and still be quite valid. Indices wise, DAX, Nikkei, UK 100, the latter, the FTSE, put in an all-time high eventually last week. They're all moving ahead, looking like they're consolidating. They're in line with the US move. All look like they could break to new highs mid-May. At the moment, the FTSE's got a lot of impetus, M&A, left, right and centre, inflows into Europe, as we're seeing, which is probably holding the dollar down or keeping it sideways. Everything's in place for FTSE and DAX to keep continuing. I've moved the stop loss up from the April 19th low to last week's low just to lock in some gains if it over consolidates. Not sure that necessarily will happen unless we get a couple of bad days at the start of the week. Looks like we're going to carry on grinding higher. It's the daddy boy index, the DAX, isn't it? Nikkei equally looks like we've put in a low along with everyone else on the April 19th. We had the early week rally, came off with Meta, and then resumed the upside. Again, let's move that stop loss up to the microwave 2 low, and we'll expect any kind of consolidation to be bought and moved on. Despite the yen sell-off, that will obviously still be good for the Japanese exporters. There's lots of inflows, as we've talked about, into Japanese stocks from domestics and overseas. Obviously, the overseas would love to have to stop hedging the yen. That's another reason for the Bank of Japan to get things normalized a little bit, stop the overseas selling. If people could believe that the yen was going to go up, then they get a double whammy. We keep talking about that overseas investment. You want to be buying a currency that's locally going to go up. We started off last week really looking at the underlying indices in the States. Let's see where they've done. The SOX was horrific, wasn't it? But that's had a massive bounce up. Apart from Intel, everything was strong for that last week, and it generally went up with the tech stocks. There's a 38 fib on Thursday, a 50 fib retracement by Friday. You'd like to see that hopefully continue over this week. We've got AMD and Samsung, Apple on that side of things. SMCI possibly could interpret as the weakest bounce back. It's a 3-wave, hasn't been massive yet. It has been selling off for a number of weeks, hasn't it, since March the 8th. Like to see that just get a little bit further up, give us a bit more strength, but it's not the heaviest weight in the stock in that indices. Nvidia, that's more important, and that's way above 50% on the retracement. Hopefully a little bit of consolidation and upside this week, and then we'll get that all-time high we're talking about on what surely is now going to be stellar results from them into that anticipated mid-May high. The Dow eked out again last week. We'd said that had bounced off. It being the leader on the way down. Was it going to be the leader on the way up? Well, it came off with Meta and then obviously rebounded. The real action was the more tech-heavy S&P and NASDAQ absolutely swallowing up that Meta disaster, which, as I said, could have been better handled and could have seen a completely more impulsive bounce. But as it was one of the best weeks for quite some time for the NASDAQ. The Dow, good to see that we're back in the positive on advanced declines. Again, we're at an important crossover on MACD. Need that momentum to continue. NASDAQ, similarly, we talked about it being the huge, so this is S&P, talked about it having the unwind of all the stocks above the 50-day moving average that had completely collapsed and was only really seeing energy and utils outperforming. That fits with the stagflation idea. Tech was really low, but then as the week progressed and post-Meta, we've had a bit of a rebound in the components of that index, and it's got back to nearly where we're looking sort of 45% trading above the moving day average. Nice to see that get back above the 50 line this week, hopefully. What there is, though, is quite a bit of volume in the current area and just above. So a lot of resistance to work with around that 51.50 level if it gets there. But that kind of move up from the lows, you'd like to see a consolidation and then a move forward from there. NASDAQ, equally, that's been very impulsive both ways. Looked like a very cathartic V-shaped recovery with everything that happened very early, midweek consolidation, and then the fundamentals took over. With all of these, it could be, a three-wave dead cat bounce. So it is important this week how we react, and hopefully the market holds in. But my bias is still for this 345 until we take out, what are now quite considerably deep stop losses. You may want to move those up to last week's Meta-inspired low. Yeah, Mag 7 continues to power the indices. The top 10 stocks are now 75% of the S&P. Incredible. That is a record distribution. And even the Chinese tech stocks got involved. The Hang Seng Tech Index, that jumped 13% last week. But as I said previously about the Eiger, the Clint Eastwood movie of the mountaineering up in a straight line. Look, it's a 40 delta of what the all-time highs were. DXY ended down 0.1% on the week. Who'd have believed it with everything that was happening and what's been happening for the last week and a half, really? It's had everything thrown at it. Geopolitics, left, right and centre. It's been a little bit of an unwind on that. It's been in a small downtrend channel, as you can see. Is that a bit of nesting before we finally break? Feels like there might be a little bit more of that for the rest of the week before it makes a decisive move either way. I want to keep an eye on, but that will help. The crosses. The EU looks solid from the euro side of things. Lots of inflows coming in. Would love to see the dollar sell off so that this proper impulsive move to the upside comes. A lot of the talking heads were mentioning how they thought June or July, and then potentially a pause subject to data. They want to get aligned with the US. They don't want to get too divergent. They know they're going to have to go first. That's possibly taken away a lot of the fears about parity and mass divergence. We've had a 5-wave overlapping move, that leading diagonal again from the lows. We haven't retested it. We thought we might. So we've either done a small degree 3-wave here for a micro wave 2, and then we're off to the races this week again. Or it may well be, with all the data and back and forth, we might put in that final dollar surge, or at least a test of its current trading range. Possible that we put in an equal legs or a spot 618 relative here before we finally break again. But we're very much on the launch pad for more EU upside, I think. UJ mentioned it. What a nightmare. Midweek, and said the expanded flat just got too big. It shouldn't really go more than one spot 236, one spot 38. That's at nearly at 1.5. Starting to look impulsive. That to me looks like the market totally in control. Market probably short gamma with all that option activity. And then the Bank of Japan meeting and the CPI disaster zone. They got nothing to fundamentally defend it. The US dollar equally going the wrong way fundamentally. So everything's against it. They don't want to intervene because that's pushing against an open door. The market, once they start intervening, will go, well, how deep are your pockets? Because they know that fundamentally Japan haven't got a reason to do it other than, they're getting concerned about the level, but the market will have deeper pockets. So even if they intervene and it bounces back, be careful because this looks impulsive. Really, every chance that this goes, even deeper before anyone takes proper profits and helps support it. Gold, we've mentioned it a number of times. I kept the sideways channel in here just to demonstrate how, and I haven't adjusted the upside one for what is now a new anticipated wave 4 low. It's put in that 3-3-5 move, classic trading flat, almost equal legs, and bounced off that big support zone just below 23 to 22.90. We thought we might have a retest midweek, and that really has eked itself out as a bunch of three waves. Again, a leading diagonal that we suggested might have a three-wave pullback before we see more upside. And that, again, is lining up for a 23.20, 23.10 big support zone that we've seen a number of times kick in. Now, obviously, yes, some people say we could have a lot more downside, and this 1, 2, 3 connector could see another 1, 2, 3 to give us 7 swings to downside. And if that's an equal legs, you're looking at 24.30 to 22.90, 140 points off 23.40. That's 2200 as just an equal leg zone. So there's a lot of downside. And my base case always like to be on the aggressive side. Base case, still all the fundamental support, more upside. We've still got a number of high degree wave threes to put in. I'm not sure we're in for a massive pullback just yet in that whole scheme of things. Don't rule it out as a possibility. So in which case, keep 2300 in mind as one where you get out of the way probably. If it goes back down this time, there probably will be downside. And we talked about silver at the start. There's lots of chatter about there being a supply issue. So very, very tight. It's had a three-wave move and has been consolidating just like gold. If gold goes up, this will get dragged up, and silver's due to catch up with the gold rally. It normally does an overtake by the time we're into topping out zone. There's every chance that silver gets thrown into the mix of global currency. That is getting ever nearer. The BRICS have said that they're looking at a blockchain mix of some sort, with details to come. And we obviously know what their background is on purchasing the underlying commodities. So everything is in a line. Silver needs to catch up. Put that onto the list of things to look at. As ever, the rest of the pack has last week, as it happened, and the dire at the end. Trade safely out there, Planty out, and I'll look forward to seeing you on the live shows.